Hello. Okay. Thanks so much for joining us at one of the final panels here at XPANSE. Have you had a good time, everybody? Yes?
Come on.
Yes, good stuff.
Hear it.
Fantastic. Well, we're going to shoot the breeze now about being an entrepreneur and dealing with investors. I've got some fantastic panelists for you. I would like to make a short apology for Katerina Almask, who from Open Ocean, who's a venture capital. She was unable to join us, so we apologize for a slight lack of diversity on the panel. We did do a lot of work to try and amend that issue, but we were unable. But we have a brilliant bunch of entrepreneurs here to talk about this subject. And let me just give you a little bit of a background here. To my right, we have Dr. Kris Naudts, who is a partner at Firgun. And Firgun is he'll be telling us about it shortly, but is going to be an investor in quantum technologies, but is also the former founder of Culture Trip, which was quite an amazing story, boom and bust story from the last few years. Next to him is Christian Vollmann, who's CEO of C1 Green Chemicals. And for those of you who are not aware, I was certainly not aware myself, actually, rather embarrassingly, of the idea around green methanol, which is an alternative fuel. So obviously very relevant for deep tech and science-based startups. And finally, Dave Spector, who's co-founder at Nanotrace. And Nanotrace, I was trying to do some research. It's very hard to find out Nanotrace because their website is yet to be launched. So we're very much hearing straight off the presses, hot off the presses today, as Nanotrace will be telling us Dave will be telling us a bit more about that. But Dave was also formerly with Sequoia, the very, very well-known, famous venture capital firm in the Valley. And we'll be bringing that perspective to this panel. So, ladies and gentlemen, let me just sort of kick this off. If I can turn to you first, Kris, as in Kris, Dr. Kris. You obviously had the panel is really, the topic today really is about founders dealing with investors and that relationship. And it is a very interesting one because it's quite often not really unpacked. It's often, in fact, actually, I would admit, even by the media, not very well unpacked. Tell us a little bit about your perspective on that and what that was like, because Culture Trip raised a lot of money and went through a lot of interesting times, and you had a lot of investors, didn't you? A lot of investment.
Well, it was a story of two halves. So by original background, I'm a medical doctor and a psychiatrist, so relatively unconventional to then start a travel startup, which I did. And the first half of Culture Trip, first 4 or 5 years, were a journey of no money. We hardly had anything, which was bootstrapping and surviving. The second half became a story of almost too much money, as in I raised 130 million for it at pre-revenue stage, which is mad. And then mad things happen. I mean, good mad and bad mad. Good mad in the sense that we had an amazing user growth, and we had 2 billion views, I think, on our social media channels in 2017-18, a bit like TikTok now, but that didn't yet exist in that way. We won 50 awards, but we also had 1 million growing pains. We went from 15 to 500 people in a year without an HR department. That's just not a good idea. And then you have to fire people, and they are not happy, and you have to battle through all that sort of stuff. We had investors, yes, in the beginning, pretty much at that time, anybody we could get, really, to be honest. I mean, like angels that gradually become bigger and better. And then there was interest in Silicon Valley to put in, I would say, 6 to 8 million in an A round, but then there was suddenly people in Europe who wanted to put in 30 million. That's hard to say no to. Sometimes I wish I had, but I hadn't. And then 30 became 100 million and 130 million and so on and so forth. And it created more problems than sustainable solutions.
Did you think that you were raising maybe too much money at the time? Or
no.
did you think, let's just go for it?
No, these were different times as well. I'm talking here 2016 to 2018. So because we had this amazing user growth, we were thought of as the next sort of Pinterest, Instagram. That's sort of how people thought of us. And that monetization had to come later and you needn't worry about that. But as Warren Buffett said, when the tide goes out, you see who is swimming naked.
Yeah.
When COVID hit, my God, were we swimming naked? I mean, and you noticed it.
Right. So that's a real sort of rock and roll ride. Dave, you've been a partner at Sequoia. Now you're an entrepreneur, and we were talking earlier about how the money flowing into, especially Silicon Valley, is kind of especially being sucked up by AI right now. What's your perspective on the relationship between VCs and entrepreneurs right now in 2024?
Well, I think there's a couple of things going on. First of all, great to be here. The money in Silicon Valley is really not making the round trip. So I don't know if people have seen some of the news, but venture capital returns are at an all-time low. And it's widely regarded if you talk to fund-to-fund managers, pension funds, any academic institution in the United States that invests in alternative assets will tell you that it's one of the worst performing asset classes besides the top quartile funds. And what I mean by not making the round trip is lots of money is coming in, or has in the last 4 or 5 years, and it isn't coming out the other side. And so there was a study done by Silicon Valley Bank where at this point in the cycle, there's 4.5 times the money coming in as the amount of money going out. And it should be at parity. In 2022, it was at parity, which is a functioning ecosystem. So there's this challenge right now in Silicon Valley because AI companies, or seemingly any company that has .ai at the end of their name, is easily getting funded. And there are a lot of other great companies out there that aren't, because because venture capital funds are being raised at a much lower rate. The amount of pressure that they have from LPs to return capital is really great, so they're being sticklers more so than they were certainly during the ZERP era about where they put that capital. So they're extra diligence, more or less. And the challenge for them is getting liquidity for their LPs. So they've looked now to secondaries. The continuity funds. That's been a big term. That term didn't exist 5 years ago, and that only is existing now because these funds have had to create liquidity for their LPs. So VCs can't function correctly given the lack of exits, and it puts a big challenge on the amount of companies that can get funded. So that's a real fundamental problem. It's a nuance right now in Silicon Valley. There are great companies out there that are struggling to raise even Series Seed.
I want to come back to that subject about VC as an asset class and whether or not it's going to be the best option for entrepreneurs in the future. So let's sort of put a pin in that for later. Christian, how much? What have you been up to? You've raised money, obviously, for this company.
Yeah, so we are a deep tech company in the chemical space. So my co-founder is leading scientist in homogeneous catalysis. He's using quantum mechanical simulation to come up with novel catalysts. And basically we're building on a long tradition in Germany, having invented almost any catalysis out there over 100 years ago. And when people today look at Germany, they see a lot of problems. But I, being an entrepreneur, I see a lot of opportunity as well, right? To rebuild Germany and to invest into also what is traditionally our strength. And where I see the big opportunity is in what we are currently doing. So have a business background. I've successfully built 3 digital businesses before going into chemistry. Teamed up with a scientist and a chemical engineer. And I think in this combination, interdisciplinary, complementary teams, I see the way forward. And when you think about the scale of the opportunity, I think it's really, really big because chemical catalysis is involved in 1/3 of global GDP. And all of it has been invented over a century ago, in essence. has been optimized over that time, but has not fundamentally been reinvented.
But so obviously, you're very much in sort of the deep tech space. So, I mean, have you found it harder to pitch that to VCs, or are you going to a particular type of investor?
Yes, it's definitely harder to pitch than a software as a service startup or an internet startup used to be, because there's a lot of technology risk involved. And it's very complex to explain in simple terms. And you know, when an investor looks at the opportunity, of course he sees the potential, but he also sees a lot of risk. And you have to de-risk for the investor to be able to invest. And that is just a lot harder to do in deep tech. And then, especially in Europe, we have this funding gap. So it's quite easy to raise money when you are at the beginning. In deep tech, you talk about the technology readiness levels. So there's 1 to 9. It's relatively easy to get to 4 or 5, but then you hit kind of the first of a kind funding gap, which means you want to build your first of a kind fully industrial plant, and that's very hard to finance.
Right. Dave?
I was just going to, I totally agree with Christian. I wanted to ask the audience a question, make this a little more interactive. Raise your hand if you're a founder in the room. All right, so a good majority, okay. And how many people, keep those hands up, I guess, if you are a deep tech founder. So anything science related. So look, about a half or so. So what Christian's saying, I think, is totally true. It is more complicated. I wouldn't say necessarily harder, but it's more complicated to raise. And we're doing this at Nanotrace, which is a biotech company based in San Francisco. It's more complicated to raise because you're not just pitching a big new app, right? Which VCs are used to. And VCs, they're interesting creatures, right? They don't really think that deeply about, they think deeply about problems, but they're a mile wide. They're not a mile deep, right? And us founders are a mile deep. And so the challenge for them is pattern recognition. And so when something is outside of a pattern that they recognize, like bio or doing something like Christian's doing, it becomes more challenging for them to get their hands around. And sort of this joke in Silicon Valley, you're building the Dropbox of Airbnb for TikTok or something, right? When you're relating a company, the X to Y to Z, that is, the reason for that is people want something to easily be able to relate to, right? And that becomes a lot harder when you're building a biotech company, for example. So try to make it relevant for VCs, try to make it as simple as possible for them to understand and relate to existing successful companies.
Right. Kris, you've been an entrepreneur, now you want to be a VC. Yeah. Having had your experience, do you feel that you're in a position to treat founders differently? And obviously, also, you're going to be investing in quantum, if I understand rightly. Yep. And that is clearly a deep tech sector.
Yeah, I think and I hope I can add value to founders for particularly, I would say, having been one that also came out of the lab and then was suddenly in the spotlight, and I had never been in the spotlight, I did not quite know what to do. And I recognize that in the quantum founders I speak to. It's a generalization, of course. Some people are more natural on stage than others, but a lot have never had that limelight quite shone on them, and that scrutiny that comes with being successful. So I think I can add value. I think I enjoy talking to them. I do think I know what lies ahead, both on the good and on the bad side, potentially, and I hope to be able to indeed coach them on these journeys. In deep tech in general, coming out of then indeed consumer tech with an academic scientific background before, I find it quite curious and a little bit frightening the capital that is now going into deep tech and how it makes indeed VCs feel good that they are in a serious space and that they're no longer investing in trivial apps. That might all well be so, but I think an immense amount of money is going to be burned because they seem to invest to feel good. And for all the deep tech founders in the crowd, I'm sure you have had that experience where you're pitching to a person and you see their eyes slowly but surely entirely glaze over, and all they remember is the top university you've gone to, and on that basis they will put some money in. And that works for seed and Series A, and then it stops working at Series B because then the money needs to be a lot more substantial, and then they all get scared because they don't really understand what's going on. And then you're in your crunch time as a company. Would
you agree, Christian?
Yes, I actually agree. That's exactly the case in our case. If we cannot show this first-of-a-kind plant in 2 years' time, we will not raise a Series B, as simple as that. And because at that point, only execution and real results is what counts. I think what has helped me tremendously in giving investors confidence early on was to build a great board with industry experts. So I have the Jürgen Hambrecht, former CEO of BASF, and Wolfgang Reitzle, former CEO of Linde, on my board and as investors. And that really helped because they understand the technology, their names signals, they've done their due diligence. So this has helped open doors tremendously.
Though you're very familiar with Silicon Valley, do you think that science-based and deep tech founders are competing so much with AI startups now that AI is sort of sucking a lot of the air out of the room?
I think it's sucking the air really out from the perspective of journalists.
Fair enough.
With all due respect.
Touche.
But it's a lot easier to get PR if you've got .ai in your domain name these days. And ironically, even if you raise a small round, big rounds obviously are always going to get lots of PR. But I think that the air in the room is sort of being sucked up. I think life sciences, deep tech, climate tech has had a resurgence recently. It was out of favor for a couple years prior to this. But that is in its own sort of little asset bubble. And anything that's outside of that, especially consumer, which my last company was heavily consumer, is much, much harder right now. And that is competing, per your point, Mike, with AI. And I also think that enterprise software is making a strong comeback too, because the stock market's doing well and enterprise software companies are doing much better that are public. So generally I agree with you, Mike. I think that if you're in the deep tech space, though, if you find the right investors, you should be able to have good conversations with people that have the capital to invest in you.
What kinds of investors are we looking for certainly, if we're thinking about the audience here at XPANSE, what kinds of investors are we looking for? Are we looking for the kinds of the Sequoias, the Andreessen Horowitz, the Accels, etc., or are we looking for a different kind of firm in the kind of space that we're here in this environment? What do you think, Kris?
Yeah, good question. I think it depends what you want and depends how these generalist funds are set up. Some have these sub-funds to deal with certain verticals, like Andreessen Horowitz has, I think, a tech bio fund. So why indeed not go knock there? I'm a big fan of thematic funds and to try and find one if there is one. And that's why I'm setting up one in quantum, to actually really go deep on that particular subject matter and to not have to deal with too many additional verticals. That's my view. And I would look in general, but that's a bit tricky to maybe state or say, but I would look for investors who have operator experience, or VCs who have partners who have operator experience. Unfortunately or fortunately, you're going to find a lot more of those in the US than you're going to find in Europe. I think it's about 7-8% of VCs in Europe have former founders or operators amongst the partners. I think in the US that's 60 to 70%. I think it makes a world of difference. I'm not saying that founders are the only people who know. Of course, that's not true, and you need outside perspectives too. But if you have a VC and there's nobody there who's ever built a company and all they talk about to you is EBITDA, you're probably talking to the wrong guy, or lady.
I would just say, I actually totally agree with you, Kris. But the one caveat I would say is, yes, it's nice to be able to say, look for this investor, and they're in your backyard in Germany, or they've got this background you're really looking for. Don't be too picky. The money is green from every VC there is. It doesn't actually matter. Getting a term sheet is what matters, and if you have options, then make a choice. But just getting those options is so freaking hard. So just focus on that, and then focus on optimizing.
I would agree with that. Yeah, get options, then choose, of course.
Don't look for anybody except for somebody that has money.
Yes, but don't extend your life for the sake of extending it, or you're going to die anyways.
Yeah.
What are the, assuming everything's going swimmingly, as we like to say in England, and you've signed the term sheet, you've got your investors, you've had a couple of board meetings, you're doing well, things are going well. What are the warning signs out there when you're an entrepreneur and some, you mentioned your VC is just starting to go like EBITDA, etc. What are the other kinds of warning signs where the relationship between entrepreneurs and their investors starts to break down? Christian, do you have any experience in this?
I mean, for me, the biggest warning sign is always when your existing investors don't want to invest in the next round, and say that very early on. That I think is probably the biggest. That's the biggest warning sign.
Hello, no thanks. Yeah.
Yeah, especially if they could, right? Sometimes they can't, right? Then fair enough. But if they are in the position, they still have money in the fund, they can do follow-on, they have it earmarked, and then they don't want to. That's a clear danger sign.
Kris?
I think when they start talking about my company.
That's interesting.
Those are the worst kind of investors.
Wow.
They're like, I took so and so public. You're like, what
exactly.
the fuck did you do? You didn't take anybody public. I totally agree with what you said, Christian, because that is really hard to navigate, is when you can't get investors to invest in your next round, and that is a sign for sure that you have to navigate, and it happens to everybody. My last company, we raised close to 100 million in mostly equity, some debt, and we had that challenge at our Series A too, where we couldn't get people to re-up that were a part of big Silicon Valley funds, and our data wasn't very good. So there was a reason why they didn't want to re-up, and we had to, in a very difficult way, navigate trying to convince people that just because so-and-so didn't invest, the company is still sound.
Chris?
I would add to that when you compose your board, or when you have your board, that the investor directors are on it, I think it's a warning sign, or a sign of trouble to come, if that investor director is actually not the person with either the knowledge or the power in the fund that they represent. Because then you're speaking almost like to the wrong guy, and then he or she needs to relay that back to the real decision maker. He or she didn't understand what you were saying, relays it wrongly, decision comes back in a very weird way. Yeah, I've seen a few awkward ones, I think.
Something that's not easy to do, but what has helped me is my board of directors is made up of, as I said, industry veterans and industry experts, and actually the investors only have board observer seats, so they are not voting on the board, and they are so far fine with it because they really respect those board members for who they are. So this is another advantage that comes with that, and also those people really, Jürgen Hambrecht is 80 years old, but super smart, and he puts the finger exactly in the right round, and asks the questions that need to be asked. So that's, I think, really, realities out there. You have to deal with realities. So you need a board that tells you, look, we have to talk about this problem, and not a board that just applauds you all the time. So I think build a good board is really a...
That's a masterful way to do it, because, and by the way, in the practical way, how that conversation goes is the VC leads you around, and they say in the term sheet, we want one board seat with one observer or whatever, and you smile and you say, oh, we'd love to give that to you, but the board is full. So we got all these industry veterans, we're happy to give you an observer seat. So it's like, that is an amazing strategy, very hard to pull off, to pull those people in early on in your company.
Do we feel that, last question, real quick answers, do we feel that we're now at a stage where, investors and entrepreneurs have maybe, we've done enterprise SaaS software, we've done some, et cetera, I think, that the science-based and deep tech is kind of very much on the map back again? I mean, obviously, some of the technologies that are being invented right now, like AI, are actually helping some of the deep tech companies to ramp up and to scale. Previously, for instance, it was quite hard to do climate tech. Now it's a bit easier, perhaps because of all the machine learning and the AI that's been done now. What do we think, Dave?
I would just say that these things go in cycles, for sure. So AI is really hot right now. I'm sure, 2 years from now, something else will be hot. It's just the way it goes. I do think that there's, for example, biotech, the amount of dry powder out there for biotech is at an all-time high. They're not having trouble raising new funds because there's been a lot more exits. So I think you've got to find those pockets of capital that work for the type of company that you're building. And fortunately for deep tech and for science-related fields, I actually think right now is a really good time because it is a little bit removed from the noise of AI, at least in Silicon Valley.
Christian.
Yeah, C1 could not have been founded without advances in computer simulation and breakthrough in homogeneous catalysis. So it's really, we're building on the foundations of those mega trends.
Kris.
Yeah, I broadly agree with what you guys say. And I think that the VC industry itself will have to continue to innovate to keep up with the innovation that happens in the companies, of course, and in science.
Okay, last lightning round. Yes or no, will the IPO markets open up next year? Dave?
Absolutely. Trump's going to make that happen. That's one of the better outcomes of Trump being elected is Gary Gensler, for example, from the SEC. Anybody in crypto knows who he is. He's already resigned. Lena Khan, who's been a huge, huge hurdle for anybody who wants to do any M&A, particularly private market M&A. She's absolutely resigning. They can't wait to get rid of her. That's going to have a huge impact on the M&A market and the IPO market, both in the United States and globally. It's a really good thing.
Do you agree, Christian?
Sorry, I didn't get the question. Mike.
I said it too quickly. Do you think the IPO markets will open up next year, yes or no?
Well, there is not really an IPO market in Germany. I hope it's going to open up somewhere else.
Kris?
I'm not sure. I'm rather pessimistic.
Pessimistic? Oh,
not in general.
Like
not in general.
It's going to happen. Come to the US.
Well, we're out of time, but ladies and gentlemen, please give a round of applause to our panel. Dr. Kris Naudts of Firgun, Christian Vollmann, CEO C1 Green Chemicals, and Dave Spector, co-founder at Nanotrace. And from me, Mike Butcher from TechCrunch, I am out of here. Good night. See you later.